Let me show you one of the market relationships that makes people stop and say, wait, why did that happen? 10-year yields go down. Nasdaq goes up. It looks simple on the chart. But the mechanism underneath is anything but simple. And this week gave us a very clean case. The 10-year yield cooled into the end of the week. Nasdaq climbed at the same time. That was not magic. It was not coincidence. It was the market quietly changing the value of money in the future. So here is the mystery we are solving. Why does a growth stock care so much about one interest rate line? Why should a software company, a chip company, or a cloud company react when a Treasury yield moves? The answer is hidden in a boring phrase that actually controls a huge amount of market behavior. The discount rate. Think of a growth stock like a treasure chest sitting far down the road. The chest may be big, but the market still has to ask one question. What is that future treasure worth today? That is where yields enter the room. Markets do not treat $1 5 years from now like $1 in your hand today. They pull that future dollar back into today's price. That pulling back process is discounting. When the discount rate rises, the road to that treasure chest gets longer and heavier. The future dollar is worth less today. When the discount rate falls, the road gets a little shorter. The future dollar moves closer to today's value. That is why Nasdaq pays attention. Many growth companies are valued less on what they earn right this second, and more on what investors believe they can earn later. So when the market lowers the rate used to value that future, growth stocks can look more attractive on paper. Not guaranteed. More attractive. That difference matters. Now let's put the real tape on the table. This week, TNX opened around 4.485% and closed around 4.453%. Only about 3 basis points lower. Not exactly fireworks. But while that was happening, the Nasdaq 100 moved from about 29,489 to 30,337. Up about 2.9% for the week. The momentum split was even louder. TNX RSI dropped as low as 21.8 and spent 7 bars below 30. Yield momentum was cooling hard. At the same time, Nasdaq 100 RSI climbed into the high 80s, with 18 bars above 70. Equity momentum was running hot. One side cooled. The other side accelerated. That is the relationship showing itself on the chart. But here is the trap. A lot of people see lower yields and immediately turn it into a one-line rule. Yields down, growth up. That sounds useful. It is also dangerous. Because lower yields can mean two very different things. They can mean inflation pressure is cooling, financial conditions are easing, and the market is relaxing. Growth stocks usually like that version. But lower yields can also mean investors are getting nervous about the economy. They are hiding in bonds because they are worried about growth. Growth stocks do not always like that version. Same yield move. Completely different message. That is why the second chart matters. You do not just ask, did rates fall? You ask, how did Nasdaq respond? This week, the response looked constructive. 10-year yield softened. TLT rose as bond prices improved. And Nasdaq pushed higher instead of rejecting the move. That combination looked less like panic and more like easier discount rate pressure. Here is the simple checklist. First, watch the 10-year yield. If it rises sharply, discount rate pressure on growth stocks gets heavier. Second, watch Nasdaq confirmation. If yields fall and Nasdaq rises, the market is accepting the easier rate story. Third, watch the invalidation. If yields keep falling but Nasdaq stops responding, the market may be shifting from relief to growth fear. That is the whole lesson. Growth stocks are not allergic to interest rates because traders are dramatic. They are sensitive because their value leans heavily on future earnings. And future earnings are exactly what discount rates push closer or farther away. One-line summary. When rates fall, future growth can look less expensive in today's dollars. This week, TNX cooled, Nasdaq heated up, and the discount rate mechanism showed up directly on the chart. So do not treat lower yields as a trade signal by themselves. Read the relationship. Rates first. Nasdaq second. Confirmation last. That is how the invisible line becomes visible.